Good morning, Baker investment students. It is Sunday, November 13th, 2022. So hope everyone is having a great weekend. Hopefully those Chiefs can get a win today against Jacksonville, I believe. I think that's who they're playing. But good week this past week for the stock market. So as some of you noted in the forum discussion post, consumer price index numbers came in a lot lower. So what that meant is the markets took that as a positive news. They priced in the potential that maybe the Fed meeting in December will only increase interest rates 50 basis points. So we'll see what happens, but that is encouraging news that hopefully inflation is getting in check, because that does cause real wealth effects for investors and for everyone. So for this week, we're moving right along. We're already in chapter 5 and 6, week 3. So, by next week, we're halfway through the course. So just remember your forum discussion post this week. Post your results. I love reading those. I reply back to everybody. And then just make sure to address the prompt. You'll have your first quiz, chapters 1 through 4. And then you'll have week 2 homework that you'll have to submit. So do ask me questions if you have your homework. So with this week, with questions of 5 and 6, a lot of it we're going to deal a lot with theory. And the idea of kind of a modern portfolio theory to reduce risk, but try to maximize returns. A lot of this stuff started from Harold Markowitz back in the 1950s. That he recognized that there are certain returns on stocks historically, but there are also volatility with these stock returns, and some can be more volatile than others, and that's what we like to measure in what we call standard deviation. So in the textbook, they go through an example where they look at Walmart that has a return of, like, say, 11.7%, but a standard deviation of 18.6%, and the Century Casinos, which has a higher rate of return over that time period, but a much larger standard deviation. So when looking at diversifying your portfolios, putting portfolio together, one of the things the authors of the textbook want you to understand is that there's correlation, which is a number that you can calculate. Actually, you have to find covariance first, which is another mathematical process. But correlation, it can be done pretty quickly if we wanted to in Excel. There's a function called CORREL, and it's a number between -1 and +1. So if something's perfectly positive correlated, it has an example of, like, if one number is 2, the next number is 4. If the next number is 4, the next number is 8. So it moves exactly. And perfect negative correlation would say 2, -4, 4, -8. So when investing in stocks, we understand, there's obviously company-specific risk and there's systemic risk, but we try to diversify away that company-specific risk. And the less that your portfolio is correlated directly, that can help offset, some stocks are doing well, maybe some are doing not, so it balances out. But if you all have that are highly correlated, they can all move in the same direction. And sometimes you just can't, bottom line, you can't diversify away systemic risk. If something bad happens again, like we saw with COVID or the Asian financial crisis or the subprime crisis, stocks are going to take a hit, and the market's going to take a hit. But you're going to read more about it into this. In general, the lower the correlation, the greater the risk the greater the risk reduction. So that's what we're trying to achieve. You're going to read about a little bit of review if you've taken finance about the capital asset pricing model by William Sharpe. That includes beta, and beta is a measurement of volatility relative to, say, the S&P 500 index. So I want you to think of the S&P 500 index as the X value, or X independent variable. So as the S&P 500 moves, what happens to the return on your stock? And if you have a beta equal to 1, it says something like this. If the market's up 10%, your stock went up in price 10%. But if your beta is equal to 1.5, if the market goes up 10%, your stock went up 1.5%. Or if the market goes down 10%, your stock went down 15%. If you have a beta equal to 0.5, it says, hey, if the market goes up 10%, yours went up 5%. And if the market went down 10%, yours goes down 5%. So obviously, the higher the beta, the greater volatility. But in investment theory, the expected rate of return on a stock, the higher the beta, the greater expected return. It doesn't mean that it's going to materialize, but for the risk you're taking on, it's saying that that stock price should adjust to the investor's risk that they're taking on based on a risk-free rate plus beta times the difference between the market return and a risk-free rate. So, but you're also going to look a little bit more on what like we call efficient frontier, page 199. It kind of has this bowed out shape that says, hey, given a trade-off between portfolio return and portfolio risk, we want to be on a highest indifference curve. So they mentioned 2 points that are on the efficient frontier, but based on your risk tolerance. There was 1 point, I think it was on point like O, that was greater than the other point, even though they were on the same efficient market frontier. You want to go where you maximize your utility and say, hey, I'm satisfied with this level of risk. Okay, Chapter 6, I think you find this interesting. It kind of goes a little bit more detail about common stocks. Obviously, with stocks, they do have benefits. If you look at the return over the historical lifetime of, say, the S&P 500, it's averaged about 10%. Of course, the trade-off is the volatility, but a 10% return, especially if you're trying to improve your net worth over the long run, you're going to get there a lot faster in improving your wealth than you would just say stick with, say, bonds, like either government bonds or corporate bonds, which may average about a 5% return, have less volatility. So, again, depending on where you are in your lifetime, generally, as people get close to retirement, they're going to reduce that risk and maybe move it more into bonds and more income type of stocks. But when you're trying to get there, you're trying to achieve a goal to retirement, most financial managers are going to recommend having some portion of your portfolio into stocks, and again, based on your risk tolerance. So, okay. With this, you're going to read a lot about the details with stocks. You're going to read about buying and selling, reading quotes. I can remember many years ago, they actually used to trade in like fractions, and it's glad we got rid of that. It's all in pennies now. But you'll understand the difference between book value, which is more of an accounting term, and market value, and then investment value. That's probably the most important thing. What is the true value of the stock? Yes, it could be this in the market. I remember like one of the forum posts, like with Nike this week, it went up like 14%. So obviously that's a market price, but an analyst or someone looking at Nike would want to say, hey, is this truly worth this price? You would do all the fundamental analysis and look at all the financial ratios, cash flows, and say, hey, based on predicted future cash flows, this is what the stock price should be. There are analysts that do that, but those things constantly change because we're always getting new information about the performance of these companies. And in theory, it should adjust back into that CAPM model to what is the required rate of return based on the risk that you're taking on Nike. So you're also going to look at dividends, how they're paid. Some companies, growth companies, don't really pay dividends, but mature companies, like one of my portfolio stocks is Evergy. It just announced that in December they're going to increase, I think, the dividend to like 60 cents. It was, I think, at 50 cents. And they've been doing that for the past 4 years. But what I do with the dividends, they talk about drips. I just reinvested in purchasing more shares of Evergy. I just do that through my brokerage account. But you're going to learn about like how these are paid. There's something called the ex-dividend date. So if you own the stock on or before the ex-dividend date, you'll be entitled to the dividend. But if you purchase it after it, a lot of times the dividends aren't paid till like a month later, even though they make a declaration. You would not be entitled to dividends. So that gives the back office some time to decide, who really owned that stock and who should be getting this dividend. You're going to look at the different types of stocks. There can be anything blue chips, the IBMs, if you will, the growths, up and coming. I would say Hamilton is still in a growth phase, even though they're taking over everything. There's tech stocks. Not a good week for Facebooks or Meta. They're laying off like 12,000 employees. So there's been a lot more volatility in the tech stocks lately. Income, these stocks would generally pay very high dividends. And then we'd have speculative, which these are kind of diamonds in the rough that you're hoping to be the next big winner. Like if you had bought Apple, say 30 years ago, or Walmart or whatever it is, but those are really hard to identify. But they're out there right now. We just don't know what that next big giant is. And then finally defensive, to try to protect between downturns in the economy. Stocks with typically low betas would be a good example. A little bit of definition, market cap stocks, less than $2 billion in worth of all the stock outstanding. Small cap between 2 and 10, mid cap, anything with a value of $10 billion or more is considered a large cap. So they do mention, the benefit of investing some internationally, so it is something they recommend you have part of your portfolio at some degree. Some mutual funds do this automatically for you, depending on the prospectus, but there are options to buy international funds, another way to diversify your portfolio. You just have to be smart about it and what risks you're taking, how much countries they're going into. I would probably lean more towards nations that have pretty solid economies. But there can be speculative investments, that merging economies too. So, and then lastly, you're going to look at some strategies. Just a simple buy and hold strategy, like an S&P 500 is an example that I just hold on these stocks, hold it a lifetime. So you can go do stocks that are more income based, that pay very high dividends. Look for stocks that have long-term growth potential, or aggressive management that you're constantly buying and selling. And I'd say to a degree, it's probably more like aggressively managed, trying to look at opportunities for capital gains. I want to be careful with my statement there, but speculative would be probably more the high-speed trading. And you may or may not be using derivatives like such short selling or any options or futures, but trying to leverage your returns. But this is also highly risky too. They point out that it's generally really hard to make bets on this, if you will. It's like the Chiefs today. We hope they win. I think they're an 8-point favorite. But they cover that spread. It's hard to do. So it's a little bit of gambling when you're doing this. So anyway, if you do have any questions, send me an email. But otherwise, have a great week. And I look forward to your forum post to talk to you online. Take care.